Hey there, everybody. This is Christian from Tribeca Trade Group, and thank you for joining me for this weekend's video. We're going to be doing a market review for the week. We're going to be talking a little bit about, I've got up in front of me last week's best performing U.S. sectors, and then we're going to be talking about, U.S. indices, global indices, which I think really are showing some momentum and some breakouts. And we're going to go through a bunch of charts just to show where I think where there's a lot of opportunities right now in the international markets, and I'm going to be going through both developed and emerging markets, and showing you where the strength is right now, where I think it is in this market. Also, going to be talking about a couple risks in this market that I see, and then also taking a look under the hood of the S&P 500 and looking at what the indices, excuse me, what the sectors are doing as well, and then talking about a few charts that also I think are positive right now. So a little bit of, whenever I do one of these weekend videos, I always like to look at the risks first and see if there's any danger signs in the market first, because if you're a trader like me, you always want to worry about the downside first, and then you can capitalize on the upside. So always want to take a look at to see where there's risks in the market. So first things first, let's just go over what performed really well last week. Just a ton of events last week. This week we don't have too much. There was central bank meetings all over the place. Obviously, we were focused on the U.S. Fed, but also the Bank of Japan met. There was also a number of other central bank meetings that took place as well that just weren't in the limelight, but still they were out there. So this week we really don't have too much. So first of all, let's just talk about sectors. Steel was the best performer last week. It was the worst performer the week before. So nice snapback. Gold miners also did well last week, and then some of the bond proxies did pretty well with interest rates. Interest rates actually moving back down as bonds rallied. So we had, telecom was moved up 2.6%. REITs were up 2% as well. I don't see utilities in there, but I think they also had a decent week. But then you also had things like that have been consistent, in semis up 1.4%. On the flip side, biotech got hammered a little bit towards the end of last week. Amgen did not have a positive drug release, so they fell down, or not as positive as the expectations were. There was also a couple downgrades. Biogen was double downgrade last week as well, which is a big part of the IBB ETF. So that was the week's underperformer. They have been the outperformer the last couple weeks. So it kind of makes sense to me that they pulled back a little bit, especially with that negative news. Also, banks were down last week again as interest rates start to move down. Again, bonds rallied last week. Banks kind of underperformed last week. They did that on Wednesday and they carried through on Friday. Also, there's a lot of moves that happen. I wouldn't read into too many of these moves that happened on Friday because it's quadruple witching. There's just a lot of things that happen, a lot of index rebalances. We talked about Apple possibly having to be sold for the quadruple witching because it's such a big portion of the indices. Every once a quarter, all of the benchmark indices, they reweight back to the benchmark. So market cap weighted in SPYs and Qs and in XLK. Obviously, Apple has really rallied since the last rebalance back in December, and that needs to be sold to be put back into weight. So we get a lot of questions about why is Apple weak? Well, it's quadruple witching, and most likely it needed to be sold in order to put it back to the right market cap weight in each respective index. A lot of people don't talk about that, or they don't know about it. Myself as a Delta One trader, I know that those 4 days of the year are some of the heaviest trading days of the year. People just don't know the mechanics behind it, but a lot of times names have to be bought to be raised, and the weight has to be raised in indices, and some of the outperformers have to be sold just on one day, and then it's over with, and then we can go back to how things work normally. So that's just a quick note about quadruple witching on Friday. Those trades are all finished now. So what I wanted to talk about was there's a few different things. Let's talk about the bad first. And then we'll kind of start. Then we'll talk about the positives. I think the positives. There's a lot more positives right now in the market. But one thing to note is the skew, option skew. So first of all, the VIX is very low. The VIX is not showing any type of volatility. But VIX and skew measure two different things. VIX takes a look at S&P implied volatility of a 30-day term, and it's really just not. It's very cool and calm, I would say right now. 1128, very very calm right now, and it's not really showing any type of volatility in this particular measure. However, when you look at out of the money options, which is what skew tries to measure. It looks at how the prices are, what the prices are showing in out of the money options, and it tries to put a reading associated with how expensive those out of the money options are. So both on the put and the call side, you have to they look at both sides, even though a lot of people associate a high skew reading with a possibility that we could go down quickly. Um, if you look at, I think I actually have this up here someplace. Whoops, not here. Here we go. Sorry about that. So take a look at this is from the SIBO website. You could see, for example, this kind of just gives you a good view when there's a reading of 145 in the skew, which we're actually above that right now. It's a 14 and a half. The odds of a two standard deviation move start to pick up. So when there's a normal reading around 120, or less than 120, but let's say 120 for now, there's about a 7.7% of a percentage chance in a two standard deviation move. So a very large move in the marketplace. Once skew starts to tick up to 145, just the odds of that possibility that the market moves in a large way in a two standard deviation move is 14.5%. So you just want to be cognizant of this, that the market is pricing in a big move right now. So where is it right now? So right now it's 154. So it's higher than one. It's much higher than 145. So the market is pricing in a very large or larger than normal expected move in the market. So take that with a grain of salt. Is it cheap to buy insurance right now? Absolutely. With the VIX that low, you could protect your portfolio really easy. You always want to be doing this, not, just like when they talk about insurance, you don't want to be buying homeowners insurance when your house is on fire. It's too late. And a lot of traders make that mistake. They'll start to buy put options when we've already gone down 1 or 2%, and now they're buying put options and they're much more expensive, and you're doing it after the fact and you're caught. So I think right now with the skew, until the skew comes back down to below, I'd say 140, 135, buy a little bit of S&P puts. It's not going to hurt you that much to buy a little bit of puts on your portfolio. That said, we did talk about this back in January when the skew got to 145, and you can see the orange line is basically the S&P. So it doesn't always mean that we're due for a big move. And we could also get a big move higher too. You just don't know. You're just taking note of a reading that's in the market and saying, hey, for whatever reason, we're implying a very large move in the market at this point in time. And you could see sometimes it has been. You could see the last time skew got to be 155. Look at what the market did. So again, it doesn't mean I'm not trying to scare anybody by showing this extreme reading in skew. I'm just saying be prepared. You have the opportunity right now to do something about it, and it's not going to cost you it's not going to cost you a lot of money to put a little bit of insurance in place. So that's pretty much one of the only negatives that I see in the market. When I talked about in what I talked about last week's newsletter, where there was a couple signs that were a little bit troublesome, were high yield bonds. They had a lot of outflows, not this week, but last week. And HYG, which is the high yield ETF, found support at the 200-day moving average. So really nice, no breakdown here. We talked about oil as well last week. No major letdown here. They were obvious. It is weak. Something definitely to keep an eye on. Is oil next week. It did bounce a little bit. You got a couple hammer bars. So basically, I would watch last week's low for oil, and I don't think there's really anything to worry about. until we breach that level, until we breach last week's low. The other thing to note is the price action is below the 200-day moving average in crude, so it's definitely not strong, and I would not really be playing anything. Same thing with the energy names. If you look at the XLE ETF, wait until this is above the 200-day moving average to really take a big position or a big swing in something. Same thing with XOP, also below the 200-day moving average. I view these as avoids. Of course, you can look at individual names and make your own determination here. Like I am long ECA above the 200-day moving average. If it breaks the 200-day, I'll be out of it. But so it's okay taking a shot or two if as long as these names, I think anyway, as long as these names are above the 200-day moving average. But you could see the whole XLE, the whole energy space is probably the weakest area in the market right now. What else did we talk about last week? Small caps. Small caps, really nice recovery. Just when they were about to look like they were going to break down last week, we got a real nice hammer bar last week. Just as we were about to get to touch the support of this breakout, past breakout line. But we found support just in that particular day. So it looked pretty, you always want to look at the end of day prices, not the intraday prices, because intraday it looked pretty ugly. But the closing bar was great. We rallied back and we actually had small caps outperformed. I think they were up 1.8%, I want to say, last week. Where's my newsletter? Let's see. I was right. 1.8%. SPY, which had its dividend, was down 0.3%. If you look at the SPX, which doesn't cover the fact that the SPY went X on Friday, it was up about 0.2, 0.3%. So not really a lot to kind of jump up and down. Obviously, we had one nice day last week. In terms of performance, and then a little bit of digestion and a little bit of volatility on the downside on quadruple witching. So there's not really much to read here in the SPY chart. Just the fact that we're above trend. The blue line is the 20 period exponential moving average on my chart. So we're above that. And as long as the price is above that, the trend, it is what it is. The trend's positive and you want to stick with the trend. I do have the value areas overlaid on my charts, and I would really like to see SPY get above 237.40. That would also be confirmation that we're really moving in a nice path and we're above the breakout zone. So watch the 20 period moving average. Again, nothing really to note here with SPY. Same thing with Qs. Qs have been really strong the last couple months. They were kind of lackluster on Wednesday. It was really about dollar sensitive names that really rallied so much with the dollar moving down. A lot of the metal space really took off on Wednesday. You can look at that SLX ETF. You can see big green candle on Wednesday. So it wasn't really about the Qs. The Qs underperformed just a touch, but they're still in an uptrend, just like SPYs. So nothing really to note there. I would look further next week to see if small caps continue to outperform. They've underperformed for several weeks until we got to last week. So we're kind of caught right in the middle of the value area. I do see a couple positives forming here. Almost an MACD crossover. It hasn't happened yet, so kind of wait for when it happens. Same thing with the two moving averages, almost crossing over here. So that would also be a buy signal. So we're almost there. They've almost triggered. You could see actually the yellow line just did cross over the blue. But the MACD did not happen quite yet. But so we're just about there, and I think that'll be very positive. Just a couple other things that I think are positive just outside of looking at the major indices. Take a look at the Baltic Dry Index. This is something that we're almost back to new highs in this, or multi-year highs. If you go back and you look at a 5-year chart, we still have a ways to go to get there. But if you look at that 1-year chart, positive, right? And the Baltic Dry moving up, I think it was up over 10% last week. So the Baltic Dry Index is a measure of global activity, so that's positive. Also, take a look at iron ore prices. Iron ore was also very strong last week, and if you overlay iron ore with, let's see if I have that someplace on my charts. I do. Okay, so iron ore you could see is that's not iron ore, that's skew. There we go. I knew I had it someplace. Iron ore was also up 9%. So really positive. That's the orange line is iron ore futures. Notice it's back to the high of where we were back in February. And notice steel names have not gotten back there. They're a little bit shy of that recent high. So there could be a little bit more momentum to go in the steel names after, there's always a report like once a week about whether the forecast, whether China forecasts steel prices and so forth. Just watch the price reaction. Some of these forecasts are not the best things in the world. Just take a look at the price action. And some of these look like, again, the buy signal has not occurred yet. You look at U.S. Steel, but it's pretty darn near close to a crossover. Same thing here as well. So this is U.S. Steel. You could look at STLD. I did go long one of these names. You can see there is an MACD crossover here. I did go long TS last week. There was a nice call buyer. This one already had an MACD, just a fresh MACD crossover here. These two lines have not crossed over yet. It's got a little resistance to get to, especially 33.57. But I'm long. This is the one name that I'm long in the space. So I think positive that iron ore and things like the Baltic Dry are moving up. I think it's positive that small caps are moving up, and a couple of the things that were worrisome seems like they're okay, including high yield bonds. But where I think it's really positive right now. Well, I don't want to jump ahead. Let's look at sectors first. Sorry, I have a knack of doing that. But I wanted to go with with my weekend newsletter and just looking at sectors, just looking under the hood at sectors. We talked about energy. I would call that an avoid right now until it gets above the 200-day moving average. Materials jumped forward last week. I talked about steel. Material was also pretty strong. So if you look at last week, the previous week, and this is how it's been the last couple of weeks, we just haven't seen a lot of these sectors having positive momentum. They've kind of been working off like a bearish MACD cross, and just didn't see a lot of positive momentum. You could see that the momentum was falling on a lot of sectors. But this week, these are the present readings, and you could see that materials have a rising on them. Consumer discretionary has a rising on them. Telecom, which we mentioned, is very interest rate sensitive. Also, looks like it's rising. So not everything is completely positive here. The healthcare names look like they're falling in momentum. Consumer staples are falling. Also, financials. Financials are the biggest weight in the S&P. So you want to keep an eye on those as well. I don't know what happened with this crazy bar on Friday. It looks like it was a bad print, but XLF did break into so don't worry about this too much. But if you look at XLF, it did fall into the value area, and we talked about the 20-period exponential moving average. It did dip below here, so I would say definitely keep an eye on financials. That's kind of my next area that I'm a little bit worried about, considering. And again, a lot of this is you look at bonds, and bonds were very strong last week. Again, not crazy strong. We didn't even get into the value area on TLT. But a bounce from the lows. I think some people thought that we were going to take that next leg lower in bonds, and rates were going to move up, but they did not do that last week. So I would keep an eye on bonds and keep an eye on financials. If financials start to move lower, it is the biggest weight in the S&P in terms of sectors. So the S&P is going to have a difficult time kind of raging if financials start to go a little bit lower. Also, what was the other thing I wanted to look at? The U.S. dollar was particularly weak. Again, this is pretty, a stronger dollar can wreak havoc for some multinational corporations. So a weaker dollar is pretty, is good for the metal space. Is also good for industrials. So the fact that we're not raging, that the dollar didn't really tick higher and get back to those recent highs is viewed as a good thing. You could actually see they had this bearish crossover as well in the MACD as well. So sectors, anything else to really cover here? I think that's it, until we see some more rising momentum. Again, we started to see this last week with SMH. That was the only sector that was showing rising momentum, which is normally a pretty good sign that we talked about in not this newsletter, but the previous newsletter. I already talked about steel names, but you could see a lot of momentum starting to tick up. When you see this light blue on all the individual names, that's usually a pretty good sign for a group. So that is the SLX ETF, steel ETF that we just kind of went over regarding how iron ore prices are ticking up. Fund flows last week, I'm not really going to go into too much about this because they get a little bit cloudy or a little bit noisy to analyze in the week of quadruple witching as dealers collapse positions. But, the one thing that stands out to me is emerging markets and developed markets, both still showing a lot of inflows. This has been going on for the last couple months, just a lot of money being put to work in emerging markets and also international developed markets as well. Europe, the Eurozone had 100, close to $170 million in inflows last week. India, which I'm going to get to that chart in a minute. Germany also had inflows. Spain, Malaysia. The only thing that really had noticeable outflows was Japan last week. And I don't know if that was a little bit of maybe taking a little bit money off the table going into the Bank of Japan meeting. The chart doesn't look like it's really breaking down, but maybe something to keep an eye on if money starts to come out. It's really one of the first big weeks of Japan outflows. Okay, so what I really wanted to, I know it's already, we're into 20 minutes of the video today, but where I really think there's opportunities is international markets right now. Look at ACWX. This is all international. So rather than look at particular, so I like to start at a very top level view, just like I like to do in the US and look at the SPY and IWM. But if you look at ACWX, this is all international. So both the developed and emerging. And you can see this just recently broke out. So really nice move since the 200-day moving average and a fresh MACD crossover, really nice for establishing swing trades. Just a new crossover on the breakout here in ACWX. So that's very bullish, I think, for international markets. And if you start to break these things down, you could actually go back here and see. First of all, why I like this is when you look further out and zoom out a bit on your charts, you'll see that we're not even close to the all-time high, which was 49 in ACWX. We're at 40. We're breaking out of the sideways range or this range at 43.57, and we're not even close to the all-time high of $49. So I think there could be a lot of upside here, and you could play this as long as we're above the 200-day moving average, which we're way above at this point in this chart. But really nice performance. And then if you start to break things down further in terms of what areas are really strong, emerging markets, same type of signals. You could see a nice MACD crossover. Again, notice that we've just recently broken above recent highs, but we're not even close to the all-time high. And you got a nice MACD crossover right here. So breaking out here, big day on Wednesday again with the dollar moving down, and a couple of days of price digestion. So the fact that these things didn't gap and go much higher and they are settling in a little bit, I think is a good sign. I also wanted to show this on a relative basis to the S&P, and if you look at for as long as the EEM ETF has been around since 2003. Is that right? I guess so. 2003, you could see how much emerging markets have underperformed the S&P since 2010. So, it hasn't broken this trend line yet, but it looks like it's pretty close. So, going back to the beginning where I talked about skew, and if you're a little bit worried about the frothiness of the S&P and the U.S. markets, one trade that you could put on is a pair trade. You can go long emerging markets and you can go short SPY. Pair trades work really well if there is a little bit of volatility that comes in the next couple months. Pair trades are a great way or a great trade to have on to kind of to shield yourself against a little bit of some volatility that comes in the market. So the fact that EM has been in this downtrend since 2010 is now starting to poke its head above this downward trend line could be a nice place to put on a long EM versus short SPY trade, especially if you're long a lot of, like I'm long a lot of single names in the US. So I'm looking for things where I could maybe put on a hedge and kind of protect myself against a move down in the S&P if one does happen. And plus, I've got a long in emerging markets, which is going to be moved differently than what U.S. stocks are going to do. I'm also just looking at some other areas of the market, international markets. China, which also we saw call activity going out in April in both FXI and in EM last week. Some pretty heavy call buying, and this is also breaking out. You could see from this area here, and same type of pattern, same type of technicals. Nice MACD crossover here, so you can kind of see that theme repeating itself. Another area that I don't think is on too many traders' radar right now is Indonesia. Just broke above the 200-day moving average. So this one you're catching, and you've got some defined support of the 200-day moving average. But this is basically going on in a lot of the emerging markets, a lot of the individual countries. RSX, just wanted to show this one because this was in the news a little bit on Friday. The S&P upgraded Russia's outlook from to positive from stable. Also, it was weak the last couple weeks and caught some support at the 200-day moving average. Nice MACD crossover. We also saw some Yandex calls that went up on Friday. Yandex is a Russia internet name. The only bad thing that happened was this weekend there was an industrial. Their industrial production came in very light, negative 2.7% versus a positive 1.3. So that was the most positive. So you might see Russia trend down a little bit on Monday because of that statistics. We'll see if that comes into play. But could be an opportunity if you didn't get involved in any one of these names to possibly to get long. Also, India. Breaking out EPI also had inflows last week in ETFs. That was in the INDA ETF, but nice inflows last week and completely breaking out. And then just drilling down into some of the other regions internationally. IFA, which is international developed, so mainly Japan and Europe. I mean, this thing looks great to me. And this is something that we've talked about in past newsletters. I mean, this thing is absolutely raging right now. 62 right now. And again, take a look at where it was, 70, 60, and it could be racing back. So, you could also do the pair trade that I talked about with EM. I think you could also do it with IFA. You could go long international developed versus U.S. markets too, because I think they're going to play a little bit of catch up here. You could look at a couple other areas. If you look at just Europe alone, very, very strong looking Feds. We talked about this in 2 newsletters ago. We went through like a deep dive of Europe and a lot of positive looking charts here. Not much has really changed since we put those charts together 2 weeks ago. EWG, which is Germany, very strong looking. If you look at France, just despite their election coming up, really strong looking chart. I also caught this one as well. This is Switzerland, EWL. Really strong looking chart. I mean, they kind of all are looking the same here, just really nice moves above the 200-day moving average. So on and so forth. EUFN, which is financials in Europe, also continuing to grind higher as well above that 200-day moving average. So we also do, I think I covered all the major macro charts and international charts. So that's really the theme of the week that I see is I want to be positioned in some of these international markets. If you're underweight, those are a couple areas to kind of look at. But I'm also going to be doing a weekly review of all the stock-specific individual stocks and option activity from last week. You have to be a Tribeca Trade Group member to get that review of all of last week's aggressive option activity. So I'm going to be going through one by one some of those names. And so go ahead and please sign up, TribecaTradeGroup.com. The special that I have on every week is basically the same special. You get half off the first month as a trial. I don't give free months out because if you're part of our elite trader package, you also get access to Slack, which is all over the headlines right now. It's one of the best platforms, or it's the best platform I've ever used to kind of share information with traders and to collaborate with traders. So we do this all week long and all weekend long. We post trades and charts that we're really interested in. So it costs me money to add new members into Slack. So that's why I don't do like a week free. Because I have to set new members up with all of our bells and whistles, and that costs money out of my pocket. But so to get involved in all of the services that we do, I don't know anybody who puts together the services that we do, including a live trading room, a live chat room, the weekend newsletter, videos that we do, and all the analysis that we do in Slack, which is really, really the leader in tech chat rooms right now. So you can get all of that right now for basically $60, $64 a month. So check it out. It's worth your while to check it out. We have a really high retention ratio, meaning people who check us out and join, we don't really see them leave. So check us out, TribecaTradeGroup.com, and it's the Elite Trader Package. You get everything, basically for $64 for the first month. Again, I don't know anybody who puts out the services that we do that you get for in one package alone. So again, I try to make it simple as well. I don't have 5 different packages, just one package, and you get all of our Supreme Elite Trader Package services. So thanks for watching today's video, and enjoy the rest of your weekend and March Madness. Thanks, everybody.